crypto cycles tend to be much longer and much sharper. Stable US dollar is beautiful. We are set up for a hell of an opportunity. My crypto bet is that it's going to destroy every other asset on earth performance-wise. It looks horrible when you see a P&L go down, but it's okay. And if you can then add more for the next run up, because these crypto cycles tend to be much longer and much sharper than we used to in traditional markets. So that's okay. I think the chances are it goes somewhere between 200,000 and 300,000 by, Feb, March next year. I mean, look, I don't have any equity positions. I'm basically all crypto. For Global Macro Investor, I've got some gold and some bond call options.
Okay.
And I'm just buying some S&P puts. I don't tend to like to buy equity puts because I find they tend to go to zero all the time.
Okay.
I don't make a lot of money out of trying to be the genius shorting the equity market, but I just feel like we've got this risk setup coming again, where we could end up with this, Wile E. Coyote moment where everybody's looking that way and the economy is about to go that way. So I think whether it's cash or some hedges, just be careful. Correlations fall apart in these things. Gold can get a washout. Even Bitcoin can get a washout later on. Who knows? Just be on your toes. This is not a straightforward situation. My way of playing that is I'm all in. I'm not expecting to close any positions until the end of the year, maybe into next year. So I will just, if I get any more cash, I will just buy a dip. And I'll be tilting it more towards Ethereum than Bitcoin. I'm currently 80-20. Add to Ethereum because I think it's going to outperform in this cycle. I'm hoping to add to Ethereum soon, and I will probably continue to add to that because if I look at the chart of Ethereum versus Bitcoin, it looks like it's basing. Usually, Ethereum is also very much following the 2017 Bitcoin cycle, both in price, in number of wallet addresses, in market cap. I mean, it's identical. It's kind of spooky, which tells you this is being driven by Metcalfe's law and adoption effects than almost anything else. So if that's the case, then we know Ethereum has a decent chance of getting to 20,000, considering right now that's a value proposition. Even with Bitcoin going to 200,000 to 300,000, one's 8x, one's 16x from here. I think there's a correction coming, as we talked about at the beginning. I think it'll hit emerging markets too. The dollar goes up, emerging markets are going to get smoked. Everything does. But in the end of this process, the dollar is either likely to break lower over time. I think it goes higher first, but over time breaks lower. Or my actual hunch is it trades in a sideways range, which is miserable for FX traders, amazing for emerging markets. Stable US dollar is beautiful. So if I look at the chart of the EEM as a simple ETF that you can trade, look at the monthly chart of that, or the underlying MSCI Emerging Markets Index, and it's just a massive wedge pattern. I mean, it's a thing of beauty. And it looks like you've got, most of these emerging market cycles tend to give 400% upsides. That's huge. And that's how it always plays out. So we are almost record undervaluation of emerging markets versus developed markets. We're the largest outperformance of the S&P in history against emerging markets. We are set up for a hell of an opportunity. And if the dollar stabilizes for any period of time and there's some global recovery, which obviously will be coming, these countries have less debts, less aging demographics, less problems, more outperformance. So, and it is generally a 7 to 10 year cycle. So you can buy emerging markets and go to the beach. My crypto bet is that it's going to destroy every other asset on earth performance-wise. And it's going to suck everybody in on a massive reflexive loop. The more the market cap goes up, the more the institutions need to buy it because they need to not lag behind the institutions that already bought it. The more it goes up, the more retail buy it. It becomes a very reflexive loop. So that is too powerful. I look at the charts of Bitcoin versus every asset and it's basically eating them all. So that will play out. And as you've said before, we know how these things end. They end up in a bear market for a while. That's normal. It's just human behavior. It's how markets work. No market goes through a big bull phase or a big bear phase without a massive reversal phase for a while. So What I'm trying to do is set up a time horizon for people to understand is, okay, this is my bet for now. May not like the crypto bet, so start looking at the emerging market bet, but I still think there's 6 months risk window here that I wouldn't do the trade. Crypto may or may not have a correction it should do, but just an ordinary correction, and then it should explode. Emerging markets, if you can buy them into a sell-off, fantastic. That will set you up. You can go to the beach and forget about it. As that trend reestablishes and it starts proving itself, you go further out into the risk curve. So you start going into India and you start going into other markets. Gold should get taken along most of that ride too. So there's a whole phasing here. So, I know people get confused, but I see things in future expected probabilities. There's a path to get there. The path isn't everything all in now. It's like, this is the phase for crypto. We're at a risk phase for markets. That risk phase for markets will set us up for emerging markets because the dollar may go up first. Then let's say the dollar stabilizes or weakens. Emerging markets will take off. It'll start sucking in equity market capital out of the US system. So that's how I see it. Everybody I know has made money from one trend, rates. Rates going lower, low volatility, massively liquid, massive leverage. So you can take liquidity preference because you're in the most liquid thing on earth. You've got time preference because rates are going lower from demographics, deflation, technology, globalization. And you can take risk in that trend because you've got leverage. So that was the biggest generator of alpha for the entire macro industry forever. The other generator of alpha is FX. Massive liquid markets. Problem is the FX trends have been getting more muted over time. As we moved into the WTO agreement, before WTO, countries used to use tariffs. And to offset the tariffs, you have to let your FX move a long way. So if you look at the charts of DXY going back to the 80s, it would go up 100%, down 50%, but it's got much more subdued because everybody's now using monetary policy to try and weaken their currencies at the same time, which is one of the reasons gold goes up, Bitcoin goes up.